Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast. We are so happy that you chose to tune in this week. So today we are going to talk about something that I like to think about on up days and down days in the market. Really every day in the market, because you pretty much get one or the other. Actually, I've seen one where there was none. No change.
No change?
That was a weird day. I think there's only been a handful ever. But
was the market even open that day? Or did you look on a Saturday?
But yeah, there was one weekday where the Dow was unchanged. It was very weird. But it went all over the place during the day and then it closed flat. So anyway, growing up in Ohio, I naturally have spent many days at both Kings Island and Cedar Point over the years. And I grew up actually really enjoying roller coasters. And I honestly don't understand how some people don't like them. I think they're crazy. But if you don't like them, I don't dislike you. That's okay.
You know, the older I get, the harder it is to ride roller coasters. I'm going to be honest with you. I grew up just like you. We went to Cedar Point at least once a year. Rode every ride. Loved it. But last couple times I've been on roller coasters, it's just been like, whoa, man, I feel it.
I don't want to feel it. When I get to your age,
so now if you need to find me at Cedar Point, I'm at that cheese fry station eating some cheese fries
or the fried cheese.
Oh, I do the French fries with the cheese on it.
It's like a corn dog, but instead of a dog, it's cheese.
Cheese inside.
Oh, so good. So yes, watch the amount of donuts or fried cheese or fried fries you eat before the roller coaster. But overall, the faster, the higher, the twistier, the better. It was awesome. Yep. Millennium Force, sidebar, is still my favorite roller coaster of all time at Cedar Point, and I've been on a lot of roller coasters, so it's really awesome. But anyway, sometimes it can feel...
I'll tell you.
Ooh, go for it.
I'll tell you. I think you could put Cedar Point up against any amusement park
in the world.
And, you know, it's just straight roller coasters. You know, we've taken our kids to Disney World, and there's a lot of cool stuff there, and they have cool rides. But from a straight roller coaster standpoint,
I agree.
Show me a place that's better than Cedar Point.
I agree. What is their theme again?
America's Roller Coast.
America's Roller Coast. So buckle up.
Just don't go during Mayfly season. If you've ever been there, oh man.
And also, don't go in the rain, because roller coasters in the rain are not fun.
They close them down.
But if they have them going, you just get pelted in the face.
Yeah, it hurts.
Yeah. So anyway, it feels like sometimes the stock market can be like a big roller coaster. So that's the theme this week. It kind of seems like sometimes your market's chugging along, clicking up the hill, and then out of nowhere, boom, the floor falls out, and you're in the dark and you wet yourself in the tunnel at the bottom.
Yep.
That might just be me. I don't know. But then it goes up again and the cycle repeats. So that's the stock market, right?
Repeats, huh? So volatility, that's normal? It's not kind of a fluke?
It actually is very normal. So in the more than 7 decades since the end of World War II, there have been more than 110 5% drawdowns. So around 1 to 2 per year on average. Over 40 10% drawdowns, which is about once every 2 years. And that's typically what I think of when I think of the term correction. And there have been over 20 15% drawdowns. So that's about once every 3 years. And there have actually been now 13 20% drawdowns in that time. And that is what we call a bear market. And that's about once every 6 years. So it's not uncommon at all. It's very, very normal to have big swings in the stock market.
So looking at all those stats, and we've seen a lot of different figures on that, when you take those all in together, the market averages about a 14% drop every year when you look at it overall. And that's what we've seen over the last 20 to 30 years is, you know, some years, like you said, there's more or less, but when you average it out, I mean, you expect a double-digit loss every year is what you should at least anticipate when it comes to volatility.
Yep.
All right, so we're going to be talking about a lot of terms. So let's first go and break down some of these terms. So you talked about a drawdown. So you'd said, you know, there's a drawdown of 5% or whatever every couple of years. And so a drawdown just means from one high point down to a lower point. So let's say the S&P 500 is at 5,000 and then it draws down to 3,000. You lost that 2,000. All right, that's a drawdown. It's just from one high point to another. So a drawdown is the downward movement.
40% drawdown.
Right. And so a drawdown is really just the term can be used for any size, but from a high point down to a low point.
Correct.
Then we're going to talk about terms like a bull market. So bulls are good.
Bulls are good.
Bears are bad.
Bears are bad.
So bull market is an upward trending market. So we use the 20% as kind of the threshold.
So not necessarily being up 20%, but just any period that does not have
it.
A 20% drop.
Yeah, so 20% is kind of that threshold.
Yep.
So as long as we're not experiencing a 20% drop from the most recent high, so there hasn't been a drawdown of 20%, we're in a bull market. Once we experience that 20% drop, we're now in a bear market.
Yes.
And until we get back up above that mark, we're in the bear market.
So as of right now, we are sitting in a bear market on 219, the S&P 500. So February 19th, the S&P 500 reached all-time highs. And since then, things have been all over the place. Kind of like that roller coaster we just talked about. So like I said, February 19th, all-time highs on 3/12. So March 12th, 21 days later, or 16 trading days later, we closed in bear market territory with the S&P 500 down nearly 27% as the market really got scared and really feared a lot of that COVID-19 stuff that's going on. This was the fastest drop to bear market territory on record.
Again, when we're talking through these things, these are terms that we use in our industry. It's all relative because who chose the 20% number to define that change from a bear to bull market? It's just an arbitrary number, right? Is it fun to lose 10% of your value? No. Could you call that whatever you wanted to? Yes. In fact, we use the word correction for any kind of period where there's a sustained drawdown. So you may hear, hey, there's a 5% correction in the market. The word correction is just meaning like that. You're correcting or moving back from a higher point. And a lot of times the correction usually comes from maybe we've had a long uptrend and the market's maybe just catching up to itself.
Yeah, kind of consolidating.
So correction is a term that doesn't have a real defined number to it, but it's referenced in the point of something similar to a drawdown. It just means there's been a movement or an adjustment. So what do you think? What is this normal volatility? How does this impact risk? How do those two interact with each other?
Yeah, that's actually a good question. So volatility really is a reflection of risk over time. So the stock market prices, every single instance where stocks are trading during the day, the prices that are being reflected are pricing in the expected future profits, revenues, dividends, and cash flows in real time, all the time when stocks are trading. So when this outlook changes, which it's constantly changing, so do stock prices. And that's actually a really good explanation as to why some of these tech giant growth companies are more volatile than something that's more established and that's been around a while, because things change more and they change in bigger ways and the outlook changes very materially, very quickly sometimes. So really, the higher the risk over time, the higher the expected returns, but your returns are going to be a lot more choppy than something that's less risky or even guaranteed, like fixed income, for example.
So really, if I'm trading a stock, the price of that stock, now there's an underlying value based on the company, but the actual trading price of the stock is based on what somebody else is willing to pay me for that stock. So if I own a share of the Invested Dads Corporation,
that'd be expensive.
And let's say it's trading for $10. It's trading at $10 because in the market, someone has said, I would be willing to pay you $10 for one of those shares.
Based on what they expect to happen for the Invested Dads company going forward.
Yep. And then if someone else says, well, you know what, I kind of want that more, I would give you $11 for the share. That's that volatility. It's now in everybody's, this trading mind is worth more money because someone is saying, I value that at a higher point. Exactly. And that's the volatility. And that's why you see fluctuations too. Did our company change at all in that time frame between the two? No, but the valuation changed because the perception of our future success changed.
Exactly. It's all about expectations and perception. So as investors, whether that be people, retail investors, or institutional investors, as these people change their minds on what they think is going to happen for a company, so does the stock price.
Yep. So news, a lot of things can impact that, like you said, and that's why there's a constant fluctuation in prices. Exactly. It's because there's always constant news coming out, not only about the company, but about our economy and the world's economy that they'll play into. So if there's a slowdown in China, well, okay, that's going to impact other companies, not just China. And so that's where you see prices here in the U.S. adjust because of that news. Exactly. Because, well, they're doing business there or they may be making products there. And so that's the volatility.
There are a lot of moving parts. And if one economic indicator comes out and on paper you wouldn't think it would really impact some company, it will. It will impact the economy as a whole and then the economy as a whole will trickle down and impact every single company that's operating in it. So every little piece of information, every little piece of news, every analyst report, every yada, 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 those are what's priced into the stocks at any point in time.
All right. Yeah, I like that. Let's take a break. That's pretty deep.
Whew.
That's
I'm sweating a little bit.
I have
That's some good stuff.
a dad joke here for you, Austin.
I'm a dad, so
It's more
I'm qualified.
it's a question more than anything, okay? So you're a car guy. You like cars, motorcycles.
I do.
So I don't know if you're younger than I am, but do you recall at gas stations the air? I don't know what you call those inflator, the air pumps.
Yeah.
Air pumps
Mhm.
used to be free. You know that back in the day.
No, I didn't ever remember.
You go to a
that.
gas station.
I've always paid like
and they
a
used
quarter.
to be free. So they used to be free.
those
Yeah,
were the
back in the
days.
day, you used to just go and get some air for free. Do you know why they're not free anymore?
Do you want another business answer or the funny answer?
To me, it's the same.
Okay, because my business answer is that they just the gas stations were like, hey, we can charge people for this.
That's part of it. But the real answer,
Uh-oh.
inflation,
Yes.
because they're air pumps. Inflation.
Oh, I know
That's
you're
the
talking
funny
about
part.
things are more expensive over time, but
Yes,
inflation.
But inflation, because they're
That's-
air pumps.
That's even better.
Because they're inflating things.
Josh, you never cease.
That,
to
by the way,
crack me up.
was a dad joke sent to me by a listener out in California. So Wade, thanks for that joke. I thought it was hilarious, so I thought I'd share it.
We love dad jokes, and we will share them
Yes.
on the show. So send them our way.
One more before we get back into it.
Oh yeah.
We were talking about roller coasters in this volatility. Have you tried those new 4D roller coasters anywhere?
I have not.
Oh man, it's incredible. So it's a moving roller coaster with visual effects as part of it. So when we were down last time we went down to Florida, we went to
Like
Universal
virtual
Studios.
reality and a roller coaster?
Yeah, so we went to Universal Studios and they have a Harry Potter ride that is like that. And so you're physically moving. You're on a broomstick is what this ride is like. But there's interaction with things around you, 3D / actual objects. Sometimes you don't know which one it is. It's incredible, but it's also, I mean, it's a lot. It's a lot of stimulation while you're riding. It's not just a roller coaster.
I was actually. So, have you ever been to like an IMAX movie?
Yeah.
So we used to go down to the Air Force Museum a lot in Dayton when I was a kid.
Yep.
And they would always have an IMAX theater there, and we would go see an IMAX every time I went down. And a lot of them were airplane related. So when you're in an IMAX theater and you are quote unquote on an airplane, you literally feel like some drops and spins and stuff like that in your stomach when you're just sitting there stationary.
Yep.
So I always wondered if you could combine some
they do.
some motion with an eye. Oh my goodness, you'd have people puking all over the place.
So this new Star Wars thing that they just opened up, I've read about, and the ride is, I forget what they call it, but it's not on a track. It's computer programmed in the floor where the thing you're in can be moved. So you have a lot more flexibility, so they can change up what you're seeing and what you're doing, and it change the actual movement of the cart and reprogram it for future changes, or they add new scenes. But it's all screens and visual, but you have physical movement as well involved in it.
Whoa,
It's crazy.
I'm gonna have to try that next time I'm down there.
All right, so that was a distraction by this.
No, that's totally fine. So, Josh, what is one piece of advice that you would give listeners when things are bumpy, things are choppy, or there's like a major sell-off happening, kind of like we just saw as we're, are now in this bear market due to the COVID-19 pandemic that's really been spreading around the world. So, Josh, what do you got?
So my advice is, one is I hope you have a financial advisor because their main job and where they earn a lot of their money is helping you through those times, making sure you're not making an emotional decision based on what's going on around you, sticking to your plan. That's the key. So, turn off the news, delete your app on your phone if it's causing you to watch it every day. You don't need to watch your long-term investments daily. That's huge. You want to come up with a plan, stick to the plan, kind of set it and forget it. That's kind of what we say. In April of last year, 2 years ago, April of 2018, Ben Carlson, who we had on earlier, he came on and talked about his book. He wrote that the more you look, the more painful it will feel. And the reason volatility clusters in the market is because losses instinctively hurt twice as bad as gains feel good. This loss aversion is a big reason why investors tend to make more emotionally charged decisions when stocks are falling. So, Ben, like I mentioned, was on our podcast, but he's speaking about what we know in our industry as emotional investing is you compound the market may be down 5%, let's just say. The average investor reacts to that and sells, which causes the market to go down more, which causes more people to react to that and sell. And it's compounding on that pain, and it causes more people to make that decision. And it's true. You feel those losses, and even though they're not real losses, they're on paper. Until you sell, you haven't actually locked in any losses or gains, but you feel that downside more than you feel the upside. To lose 20% is harder than to gain 20%.
And it's
from a good side.
That is, again, like you said, that is why it is important to work with a financial advisor, because they are able to help put your mind at ease, to stick to the plan, and that whatever's happening right now is only short term. And if they're not telling you that it's impacting your overall financial picture long term, it's not. So it's not worth getting hung up on. But that financial advisor is worth every penny and more than you will pay them in their fees by talking you out of doing something stupid and selling at the bottom.
Yeah. And that's really timing is a losing game for I'm going to say anybody. I mean, there's probably people out there that think they can do it. And for some time they might, but timing, you have to be right when you buy and when you sell. And that's a lot to ask somebody to do perfectly every time. And so that's why sticking to a plan matters. Look long-term. What am I trying to get to? And in the interim, historically speaking, what has gotten people there the most efficient way and the most likely way? Stick to that plan.
Stick to it. Stick to it, and everything will be just fine. So, kind of going back to volatility, I guess it's important to remember that you really don't lose a dime unless you sell, like you said. And at least that's what Nick Murray's book, Simple Wealth, Inevitable Wealth, says. Great book. We'll link it in the show notes. I read that last year, and it makes things at a very high level make a lot of sense, and it should for a lot of people. So that's good. But he says the ability to distinguish between temporary volatility and permanent loss is the first casualty of a bear market. So overall, like a 30, 40, 50% stock market drop, totally not fun. Like no one wants to look at their statements or whatever. But it really doesn't change your financial situation unless you need that money right now, or if you're selling at the wrong time, sell at the bottom or when things are down. The market will go up over time. We know that because it historically has done that. And the U.S. economy is going to continue to grow, and we have great faith in the system that we have in place there. And like I said, this is the reason why working with a financial advisor is a game changer. They can make sure that you're not making poor choices and selling at bad times, and it's just going to save you a lot of time and avoid you from doing something that can make you permanently damage your plan.
Yeah, and a lot of times if you're looking on the TV or the news, they're there to sell, advertise. We talked about this in the past. They're there to sell, to get the eyes, to get the viewers. And so what are they going to highlight? This is new. This is something that's never happened. It's, the markets go up and the markets go down. And in the long run, the U.S. economy continues to innovate and grow. And that's what we're betting on. That's what we're believing.
And it's just so funny. If you watch the news, it doesn't matter who you're watching, all news is going to be more highly rated as news for the negative stories that they're putting on there than the good stories. So specifically looking at financial news, they're going to have a lot more readers, a lot more eyes on the TV when the Dow is down 20% and everything's flashing red and there's bears all over the screen than they are when you're just slowly chugging along in a nice upward year. You know, it's not good news that things are going well all the time.
That's boring.
That's boring.
Yep.
So Josh, what do some people tend to take safe haven in when things are choppy, and why is that maybe not the best move for your financial plan?
Yeah, so like you mentioned, when people get scared, they want out of that volatility. So they want out of the stock market because that's the volatile piece. That's the growth piece. Volatility is up and down. So where do they go? So there's a couple places to go. They can go to fixed income. There's some volatility there, but it's less volatile.
And sometimes inverse of a stock market.
Yep. And so it moves a little differently, uses different reactions to things. And then there's gold.
Yep.
So the idea there is that's a hedge against volatility and inflation as well. Gold being a physical, limited object here that we've attributed to value. So there's only so much gold in the world that can be mined out of the planet. And so that adds a scarcity to it, which adds value to it.
Supply and demand.
Yep. And then more recently, apparently, according to Austin, which is crazy, Bitcoin has become a safe haven for volatility.
It is so funny because we're talking about how people think the stock market is volatile and they're flocking to other things. But the truth is that on crazy stock market sell-off days where the market's down 1-2%, whatever, people buy Bitcoin like crazy and Bitcoin goes up more than that. It's crazy. But they're they're getting out of one thing because of the volatility and getting into something that is actually much more volatile. So it is counterintuitive, but it's the truth of what people are doing. And I have my own opinions on that. I do not think it's totally a great move, but it's interesting that that's what people are doing.
Yeah, because if you look at the historical volatility of Bitcoin, it is a volatile thing in and of itself.
True.
And so to think that would hold up. And then obviously the last one is cash. So, I was kind of working down that list. Bitcoin kind of got thrown in there. I think it's a little more volatile than all those, but they look at that as kind of something similar as a different digital currency, I guess, in a sense. But cash is kind of the last one. People will sell and sit on cash. Now, historically, you could earn something from your cash. Currently, you can't earn much. There's really not much there. In fact, it's usually below inflation. And so that's the downside is if you're holding cash over time, you're actually losing value in that cash. Even though it stays the same dollar amount, what you can buy from that goes less and less every year. So what do? Let's talk about kind of an idea that you can do during this volatility. So there's this cool thing called dollar cost averaging. All right. So dollar cost averaging, that's for someone who is continuously adding money into their account. And when I say continuously, I don't mean like every second you drop $1 in. It means on a periodic plan, some sort of plan, you're adding money in regardless of what is going on outside of you. And so you say, for instance, payroll, right? If you have a 401k or something like that, you say, okay, I want a portion of my paycheck withheld and put into my retirement account. That's dollar cost averaging because they do that on the pay period, regardless of what's going on. They don't say, oh, the market's up a lot, let's not put it in right now. They say, it's pay time. You told me to withhold this much. It's coming out and going into the account. And so dollar cost averaging is a great way to take advantage of volatility.
Yeah, for sure.
Because what you're doing is you're buying every time some set amount of dollars, regardless if it's up or down. So as the market's going down, every time you add new money, and guess what you're doing? You're buying cheaper.
More, yeah.
Yeah, you're buying stuff cheaper. Yep. So if it was at $10 and now it's $8, you can buy more. That's great. So you're buying more at a lower price. And then when the market's going up, you're buying less, but you're still adding. And what that does is it smooths out. It gives you a nice average return.
And if you're invested in multiple asset classes or multiple investments, which most retirement plans are going
diversified,
to have, are going to have some level of diversification. Those pieces move differently. Even regardless of how the market's moving, those pieces are either going to capture more or less of the upside or the downside, each piece differently. So when you're dollar cost averaging, you're just as you are in the total amount, even within these individual buckets, you're buying more of what's cheap and less of what's expensive. And it's a beautiful thing. And it's really like it's an automatic portfolio rebalancing tool.
Yes. Yeah. It will help your portfolio stay closer in line to what your asset allocation should be or what you set it up as. Now, last 2019, when the markets are up 30% in the stock market, it could get a little bit out of whack, even with dollar cost averaging in. But in general, you're right. It does help keep you a little bit better balanced through that. And, I mentioned the 401k, but you can do that on your own because now with technology, most investment platforms allow you to set up a reoccurring amount. So you could even say, hey, weekly, take $10 from my bank account, move it over and invest it. And you could set it up to do dollar cost averaging on your own if you don't have a retirement plan at work. So there's a lot of opportunity out there for you to do that.
So Josh, is market volatility good or bad? And if the constant ups and downs of the market are too much, what can people do to kind of be able to sleep at night?
Yeah. So market volatility is neither good or bad. It is indifferent. It was a trick question. It is indifferent. Market volatility is just a part of investing. It is a piece of it that doesn't go away. You can try to mute it or increase it. We talked about that, you and I, just on our own. There's things out there that you can increase volatility or decrease it.
Correct.
In doing so, you're also giving up or enhancing potentials. So, you could play with volatility, but volatility is still there. There's volatility in investing. Historically, the more volatile something is, the greater potential of returns. And so you factor that in. And when you look at asset class and your overall allocation, if you want lower returns, or who wants low returns, but if you're willing to accept lower returns, you could accept lower volatility. So a lot of times people in retirement are leaning that route as they don't like those big fluctuations. They say, you know what, I'm retired. I know how much I need to survive on. I need X amount of returns. I don't need extra returns above that. And so they can reduce some volatility just to help stomach that ups and downs.
Yeah, sometimes in retirement specifically, it's not about can you take on that additional risk to be in more equities or whatever and that volatility. It's why would you maybe take on that extra risk if you don't have to?
Yeah.
If you know how much you need and that your financial plan is set and it should do well to provide for you for the rest of your life, maybe you don't. Why would you take on that extra risk if you don't have to? So that's why some people might achieve less return, but they're also going to take on a lot less volatility and it'll really make them feel a little bit better about how things are.
And so in the long run, because of the way our market is set up, there's new information coming in. There's a lot of people who like to try to play that game of timing. That volatility is what they're playing into. That's really what they're anticipating is, I'm going to buy now before the volatility kicks up on the plus side, and I want to sell before the volatility kicks in on the downside. That's the timing aspect of it. We think you accept market volatility. And again, going back to Austin's stats, the longer time frame you have, the less that volatility matters. Volatility is a short-term issue. If I am looking at a 15, 20-year window, those ups and downs, even those 20% drops that will show up throughout there, are less impactful because compounding is stronger than that volatility.
So, I mean, I guess it kind of depends on your age and where you are in your investing, but young people specifically, first of all, should not be scared of volatility because of the dollar cost averaging aspect. If you're systematically putting money into the markets on a set amount, a set time frame, you can take advantage of volatility.
Right.
And you have a long time horizon where taking advantage of that volatility will benefit you.
Yeah.
So the younger you are,
the more you should hope for downward movement of the market.
Yeah. Actually, I think it was in that Nick Murray book that we talked about also, but he said that the younger you are, the more you should hope for long and deep bear markets.
Yep.
Which sounds counterintuitive because no one wants to lose money on paper, but you're buying things so low and that's going to impact you more in the long run when those things grow over time. So yeah, the younger you are, I mean, Josh and I would probably both say you need not every single person in the world, but the majority of people who are saving for retirement that are going to need that time to do that, they need to be 100% in equities when they're young because that is the only way that they're going to grow to achieve their goals.
Yeah, I mean, it obviously depends on your risk tolerance because what it all comes back to is how can I stomach this when the volatility hits? Because you'd never want to be invested too aggressively where you're going to panic and make some moves. So as aggressive as you can be, that's how you should be invested as a young person.
Especially when you're young.
Yes, because that's the compounding is huge. The more time I allow my money to work, the more the more that will grow. So a 20-year-old has more ability to grow their money than a 30-year-old does for retirement because of that the 10 years, that 1 decade difference is huge. A 20-year-old to 30-year-old is bigger than a 30 to 40-year-old. So again, the closer you get to retirement, the less your money has time to grow.
Correct.
So the volatility is, a big factor in the closer you get to retirement.
And as you get closer to retirement, you need to know that you're going to be using that money to live. So it's natural. And a lot of financial advisors advise their clients to slowly bleed off some of that equity exposure and put it into something that's going to be a little less volatile as they get closer to retirement and they know that they need that money before long because they don't have that time if there was a big drop to recover it. So volatility, like Josh said, it's not good, it's not bad. That is the nature of specifically the equity markets are the biggest example of this. Things change all the time and stock prices change all the time and people feel it. But the truth is that it presents a lot of opportunity. And like Josh said, if you have problems with that, first of all, be sure to talk to your advisor because they will be able to help you out. Second of all, just try and not to look at things as much because those are things that can really make a difference in really your comfort level with where you are at in your financial plan.
Yep. So, thanks for listening to this. Volatility is a fun topic.
Although, admittedly, it's a lot more fun to talk about when you're not experiencing a bear market. But nonetheless, volatility it's timeless. It's something it's just the nature of the beast with equities, and that's kind of what we're dealing with right now. So, Josh, what do we do in these times of volatility? What do we do with our money?
We expect to invest money when we have that and grow it as the market recovers, and that's how it works.
Speaking of growing it, we need your help to grow this podcast. So if you like what you're hearing, we are thankful for that you're here, but we'd appreciate if you'd subscribe. And if you really like it, leave us a review on Apple Podcast. Don't forget to email us any ideas that you may have for topics or questions or anything you've got to hello@theinvesteddads.com. We also will read your dad jokes if you send those in.
That's right.
So send those in too. And just be sure to share this episode with friends and family if you enjoy it. All right. Thanks. Have a great week.
Yep. See you later. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.